This specialized indicator stands out for scalping exclusively on the 1-minute timeframe charts. Throughout this guide, you'll gain a complete understanding of how to leverage it effectively to detect some of the most dependable buy and sell signals available in short-term trading. Make sure to absorb every step presented here, as they form the foundation of reliable execution. Let's dive right into the practical application without delay. To get started with implementation, navigate to the Indicators menu within your preferred charting platform. Perform a precise search for 1-minute easy scalping, specifically the edition developed by Bull Trading. Once located, apply it to your chart. Observe how seamlessly it overlays directly onto the price action, providing an intuitive visual layer for analysis. In the sections ahead, a thorough breakdown of its components will be provided, along with essential setting modifications and precise instructions for generating buy and sell signals tailored to the 1-minute timeframe. Begin by accessing the indicator's dedicated settings panel. Scroll downward through the options until you reach the relevant toggles. Activate the trend average feature right there. Configure the length parameter to precisely 1. Adjust the offset value to 2. The multiplier setting at 21 performs optimally, so retain it as is. Confirm and apply these changes. With these adjustments in place, the indicator now aligns perfectly with the demands of rapid scalping environments. Now, let's dissect exactly what each visual element represents and its role in decision-making. The prominent yellow line, rendered as a dotted trace, embodies the trend average that was just enabled. This line serves as a critical reference for detecting emerging changes in the market's longer-term directional bias, helping traders anticipate broader shifts beyond immediate noise. Adjacent to it lies a dynamic line that alternates between green and red hues. This is the Hull Moving Average, engineered for superior responsiveness to momentum alterations. Further, two purple lines flank the price action from above and below. These denote the average true range ATR bands. They prove invaluable for establishing stop-loss positions that adapt to volatility. Notably, this indicator operates across multiple timeframes simultaneously. While optimized primarily for the 1-minute chart, where it shines brightest, it incorporates supplementary data from 3 additional higher timeframes set by default to 10 minutes, 15 minutes, and 30 minutes. These are pre-tuned for the strategy outlined here, so avoid any modifications to preserve peak performance. Returning to signal generation, the yellow dotted line plays a pivotal role in trend change identification. As mentioned, during a declining downtrend phase, price consistently resides below this yellow boundary. Conversely, in an advancing uptrend, price maintains a position above it. Therefore, instances where price crosses above or below the yellow line often mark the inception of a fresh trend direction. However, these crossings do not guarantee validity in isolation. Solely on them invites numerous false signals, particularly amid sideways trading ranges where price oscillates flatly, producing repeated crossovers without commitment. Interpret such crossings merely as preliminary indications that a trend may be coalescing. 2. Structure this clearly. The long position configuration will be detailed first, followed systematically by the short position counterpart. For a textbook long position setup, envision price originating from below the yellow line, decisively crossing it upward to establish supremacy above. Proceeding to confirmation, the Hull Moving Average line must subsequently cross the yellow line and close above it as well. In practical observation, once these candles finalize, the Hull Moving Average resides firmly above the yellow. At this juncture, both price and Hull Moving Average share the space above the yellow line. The Hull Moving Average now becomes your tool for detecting momentum fluctuations, opening doors to high-probability entries during corrective pullbacks. Note how it fluidly changes from green to red and back, reflecting bullish or bearish pressures. Within a long setup, patience dictates waiting for the Hull to shift to red, signaling a likely pullback provided it remains positioned above the yellow line. This red phase indicates temporary retracement within the uptrend context. Advancing further, anticipate the pullback's conclusion via the Hull reverting to green. This color restoration suggests the correction has exhausted, paving the way for resumed upward price progression. Upon this candle's closure with Hull green, the buy signal solidifies. In live trading, initiate the long position as the subsequent candle initiates. Position the stop loss immediately below the lower purple ATR line. As previously noted, for volatility-adjusted protection, set the profit target to achieve a 2-to-1 risk-to-reward ratio. Reviewing the chart, this entry yields substantial profitability. Importantly, while price and Hull moving average persist above the yellow line, subsequent red to green transitions on Hull permit additional long entries. For instance, another opportunity arises here. Enter long with stop below ATR and 2-to-1 target. Post this. Hull reddens again. Then greens sees yet another long under identical rules. Both deliver profits, illustrating pullback chaining's power. Yet, similar signals near trend exhaustion can deceive, coinciding with reversals. Here, red to green prompts a long, but it fails. To minimize exposure maximally, concentrate exclusively on the inaugural pullback after fulfilling prior conditions. This selective discipline elevates consistency. Shifting gears, the short position setup mirrors yet inverts the logic. Seek price descending from above the yellow line, crossing decisively below. Follow with the Hull moving average line penetrating below yellow. Candle closes confirm Hull's subordination. Pullback identification resumes via Hull in shorts. We'll wait it turning green, hinting at an upward retrace within the downtrend while staying below yellow. Patience proves essential here. Green may emerge tardily, as in this example, or abstain entirely. Adhering rigidly to each sequential rule minimizes risk. Accounting for post-cross fluctuations or range-bound drifts where markets defy ideals. Observe Hull greens, then reverts to red upon candle close. Sell signal confirms. Enter short on next open. Stop above upper ATR. Profit at 2-to-1 ratio. Chart affirms a highly rewarding outcome. Methodical following sidesteps abundant false positives. Case in point, price surges above yellow. Hull joins. Long setup cues red to green, but upon greening, both retreat below yellow. Reject long outright. Instead, monitor for short viability as they breach downward. Notice this. Range forms. Price flits above or below yellow. False signal minefield. Yet strategy's confirmation tiers typically invalidate prior steps pre-final entry, averting traps, not infallible. Especially ranges, hence supplementary checks. Prime non-trend detector, while price action scrutiny. Auxiliary, ADX indicator. When its line dips below 20, as here, it declares non-trending, flat price regime stand aside. Even fortified, false signals persist unavoidably. Total elimination defies trading reality. Losses integrate inevitably. Optimal response / risk exposure rigorously. Manage positions impeccably. Exemplary tactic, cap risk at 1% of capital per trade. This preserves viability amid strings of losers, fostering enduring profitability. There you have the exhaustive protocol. Thank you for following through. Post questions or insights in comments. Responses forthcoming. Trade wisely ahead.